everyone thinks the property boom must be over, but what the data is actually saying is that the boom is only just beginning. Because when we looked under the hood and we found 5 forces that actually drive the market, which are quietly lining up right now for the first time in a really long time. So while the headlines are screaming affordability crisis, the real story is a little bit hidden below the surface. So what we are going to be walking through today is we're going to show you by the end of this episode, hopefully, why the next property cycle might already be underway. So are we ready to get stuck in?
Yes. I am ready to get stuck in. I'm ready to get stuck in because there's so much. There is so much that we're going to unpack today because a lot of people think that the property market is basically just supply and demand. But there's a lot more to it than that. And in fact, I started pulling on some curiosity threads and I uncovered stuff. I uncovered some stuff yesterday, which managed to get it into the presentation today, which has the process of pulling this together, let me just say, has fundamentally reshaped my view on the entire real estate market structure. And if you pay attention to some of the stuff we're going to be talking about in this episode, it is possibly the most transformative new way to look at the property market that I've seen in a long time. This is not something you're ever going to hear. It's not something you will have heard anywhere else. That I can promise you, that I can absolutely promise you. So let's get stuck in, Gabby. Do you want to control the slides or do you want me to control the slides? You're going to control the slides. Look at that. All right. Okay, so we're going to be talking, yes, Bex, your head is going to explode then. So by the way, I just want to start by saying some of you like it when we go really kind of deep and nerdy and into the numbers, and some of you don't. And for those of you who struggle when we go deeper into the numbers, we are going to be talking about some kind of like more kind of complex stuff in here, some economic stuff, some some kind of like very data-driven stuff. And if it doesn't make sense to you on the first go around, I really want to encourage you to go back and listen to it again because we're going to be covering some really, really important stuff here. So
also, just before you move into it, with that as well, if you're watching it back through, like if you're joining us, we have a lot of people obviously that join us live every week, which we love you guys. But also most people seem to watch it in the replay. So if you're watching it on the replay and something comes up and you really don't understand it, or you have a question, or you have you have some kind of perspective that maybe challenges ours as well, just chuck a comment on YouTube and we will circle back to you as well.
Awesome. Well, we've got a lot to cover. So I want to get through this. And by the way, if you are joining us here live, don't be afraid to ask questions. We're going to try and get through all of the content first because that's the most important thing. Then if we've got time, I want to take time to go through the questions. So feel free to stack those questions up and we will try and get through them as well. And that is also a reminder, if you don't get to make it here live with us, by the way, you can leave questions in the comments on YouTube as well. We'll come back to you on that. And of course, you can join us in the Investor Lab community where there is a link below. But Gabby, let us get stuck into it. So we're going to be talking about, is the property market about to explode? And that was the question. And I came into that, I wanted to ask that question from a fundamental basis to actually just say, well, is it or is it not? And so if we go to the next slide, a lot of people think that the property market is driven by supply and demand, but there are actually 5 macro forces that drive the property market. Those can you tell that Gabby's controlling the slides and I'm trying to anyway. Those 5 forces are liquidity, which is money creation. It's kind of the fuel that drives the markets. It's the oxygen of markets. Liquidity, demand, supply, confidence, and policy. They're the 5 macro forces. So liquidity is like the fuel, demand is like the engine, supply is the constraint, confidence is the catalyst, and policy is the gatekeeper. Now, each of these 5 forces influences the macro property market. Now, when we're talking about the macro property market here, I'm talking about sort of at the national level. Now, if we go to the next slide, Gabby. So the macro is really at the national or structural level, and this is and it's got these 5 forces which I've identified and which we covered here: liquidity, demand, supply, confidence, and policy. And the macro sets the overall direction of the market, and it determines whether the tide is rising or falling as a whole. Okay. Now, somebody in the community, apologies, I can't remember. Maybe it was Ben. I can't remember. Said, oh, are we going to unpack some of like Dashdot's kind of proprietary AI signals and stuff? Actually, most of our stuff at Dashdot, whilst we do take in macroeconomic indicators and stuff to inform a lot of our stuff, the orientation of what we've sought to achieve is really at the suburb level. That's where we've really developed the most expertise. And so you have the macro, and then you have the micro, which is the suburb level. And that's really driven by the three main driving forces that we've talked about before at the suburb level, which is jobs, lifestyle, and relative local affordability. So if the tide is rising, the micro then determines where the tide is going to hit the hardest. It's not going to be evenly distributed. So it helps us to work out where the performance is going to be concentrated, or where outperformance is going to be concentrated in specific geographies. So in today's episode, we're going to be talking specifically about the macro, and we're going to be looking at high level drivers.
So just to simplify that quickly, is it fair to say that like macro is thinking about what influences the property market generally, like property as an asset class in Australia, and then the micro is more about, okay, within the property market, within the property asset class, how does that get distributed around?
Yeah, because
the country,
it's not evenly distributed, right? And that's it's not evenly distributed, right? And so we're definitely going to be looking at that like property market level, and then with beneath that, it'll be the results will be unevenly distributed. So let's go to the next slide. So this chart here is actually from the Cotality, formerly CoreLogic or RP Data monthly housing chart pack. What's interesting here is you can see that in the last 12 months, dwelling values rose. So in aggregate dwelling values rose by 4.1%. Now, if you have a look at the graph on the right hand side there, what you'll actually see is over the last 10 years, the majority of the time, regionals have actually outperformed capitals. Now, there was a period of time between August 23 and say, early 25 or late 2024, where capital cities actually outperformed regionals. But that was the smaller capitals, the minor capitals, which you would consider Perth, Adelaide, and Brisbane to be the driving forces behind that. But broadly speaking, and this is just pay attention because all of this matters, right? All of this matters. So regionals have actually particularly since say, even August in 2017, most of the time regionals have outperformed capitals. So I just want you to just these little nuggets, I want you to just let them sit in there because they're all going to start to weave together. Now, what I also find interesting about this is the annual growth trend shifted higher for the second consecutive month, ramping up from a low of 3.6% over the 2024 to 2025 financial year to 4.1% to a 4.1% rise over the 12 months to August. So that is a signal that the property market at a national level is the growth rate is increasing, which is interesting. Now let's go to the next slide. Actually,
can I actually just comment on something? What came to mind with this? Just looking at this quickly, this is not a thinly veiled like plug for Dashdot, but I did honestly look at these numbers, and our average year one growth is 22% at the moment. And so
22%. I thought it was only 20.
It's 22.
Wow.
And so I like, even in like regional areas where we've historically kind of bought, we're still outperforming that, which again, I'm not trying to, that wasn't a plan. I was just looking at those numbers. I'm like, we actually do like significantly better. So
and we're still waiting to update the latest
the latest quarter
monthly latest quarter's results. But in the previous quarter, the average or the growth that Dashdot suburb or suburbs that we'd been buying in over that previous 12 months was roughly 20% growth. I think it's 20.4% growth versus 4.1, so roughly 5 times better. So this points to the idea that performance is unevenly distributed, and that's why it's very important to understand that.
Yeah, and that's where the micro indicators come in, right?
Correct.
Yep. Cool.
So we're going to be talking about liquidity. Hey, Braden, nice to see you here as well.
Braden.
We're going to be talking about liquidity, and let's just quickly move to the next slide. So I'm really struggling with not controlling the slides. M3 money supply is liquidity, right? So M3 money supply takes into consideration all of the base money. So base money is actual like physical dollars and notes and coins that are printed in circulation, and then M1 is a slightly broader view that incorporates, I think savings, and then you basically continue to expand it till you get to M3, which also includes credit, which is very, very important to understand. So we can see that here that M3 is in a clear growth trend. Next slide, please. And in the last 12 months, M3 money supply grew by 6.8%. want you to pay attention to that because that's a very important number to remember. So it grew from 3.07 trillion to 3.276 trillion. That's a $206 billion expansion in M3 money supply in just the last 12 months. So the important number here is that it grew by 6.8%. Now, for those of you playing at home, will recognize and that have been listening to our episodes in the past, that's 6.8% monetary debasement in the last 12 months, which is very interesting. So let's go to the next slide.
Just to clarify as well. Just to clarify, because I may have missed it, M3 in this case, it's Australia only, right?
Yes, sorry, we are only in everything we talk about in today's episode is Australia only. Everything is Australia only. All the data is Australia only.
Which even if like for someone that doesn't necessarily pay attention to M3 money supply levels, a lot of the metrics, I guess, that are reported more publicly, everything's kind of more focused on the US. So even just being aware that this is also happening in Australia as well. Next slide.
Next slide. Okay. So that is a 65% acceleration of M3 money supply growth versus the prior period. So a little table here shows that August 2022 to August 2023, M3 grew by 3.1%. Interesting. In fact, I may actually need to take control of these slides, Gabby, because I might need to bounce around a little bit.
How do we do that? Okay.
We'll have to think about that. Or I might just need to quickly tell you which slides to jump back to at a certain point, because I need to be able to link some of these numbers back because these are really, really important numbers to clock. So August 2022 to August 2023, M3 money supply grew by 3.1%. August 2023 to August 2024, M3 money supply grew by 4.1%. Now, does anyone remember where we last saw 4.1% in this presentation? That was the growth of property in the last 12 months, right? So go back to this chart. So so 4.1% growth in the property market and property prices in the 12 months to August 2025. But then go back to slide 9, Gabby. So August 23 to August 2024, the exact 12-month prior period, M3 money supply grew by 4.1%. Now I saw that and I thought that's interesting. Now, if we also have a look at the August 2022 to 23 period, it's 3.1%. Now, if you go back to slide 5, Gabby, the totality slide, So what you'll notice here, and I made a note of this, is that the annual growth rate for FY25, which is from July 2024 to June 2025, was 3.6. So I saw those two numbers and I thought, that's pretty interesting. That starts to feel like there's a little bit of a correlation because 3.1%, it's not the same measurement period, but okay, you can see that ramp up. So let's go back to slide 9. So then from August 2024 to August 2025, the growth rate was 6.8%. So that is a 65% acceleration in M3 money supply growth versus August 23 to August 2024. So 4.1% to 6.8%. That's a 65% increase in the growth rate, which is basic. That's pretty fast acceleration, right? And some of these notes I actually made before I completed the next bit, but also note that M3 growth in a year to August 2024 was 4.1%, the same as national property price growth in a year to August 2025, suggesting a potential correlation with a 12-month lag. So that means that means that there's a potential correlation. And again, I wrote this before I did the next bit because I finished the last bit last night. Further, the 3.1% to August 2022 to 2023 M3 growth closely aligns with the 3.6% national property price growth in FY25 and would suggest alignment with a sloping trend, which makes sense. If we go to the next slide. So, and this is where I started to do a correlation analysis because I thought that is a little too coincidental. So, Gabby?
Just quickly, I just wanted to summarize. So effectively what you're saying is now, having looked at this data, you've built somewhat of a hypothesis of in a 12-month period, measuring M3 money supply, so money creation in the system. 12 months later, we see the same effect in property prices.
That was my suspicion. That was my suspicion. I was like, okay, these numbers look too similar to be just purely coincidental or serendipitous. And so I was like, okay, that's interesting because it appears that there's a 12-month lag. So then I went and did an analysis on, I got the totality price information over the last whatever, 30 years or whatever, plus the M3 growth. And I did a correlation analysis. Now, I'm going to walk you through this. I'm going to walk through a little slowly. And by the way, in the chat, let me know if this makes sense. So from the year, we went back 20 years to 2005. So 2005 to 2014, the best lag correlation was 12 months, right? And you can see that in the second column there, the best lag is roughly 12 months. So that means in all of the periods where we analyzed the correlation, we found that the correlation was highest when you separated M3 and property price growth by 12 months. So that is to say that if M3 grew by 5%, you would measure 12 months later what did property prices do, and you would draw a correlation there. So in 2005 to 2014, the correlation was 0.35 to 0.45. So that's roughly a 35 to 45% correlation, and the beta elasticity was 0.45 to 0.55. So let's just call that 0.5 for simplicity's sake, right? So what that actually means is that for every 1% in M3 growth during the period of 2005 to 2014, for every 1% in M3 growth, you would have 0.5% of property price growth 12 months later. Okay.
Mm-hmm.
So that's what that means. So the lag is 12 months, and the beta is, we'll call it 0.5. So that means for every 1%, you would get 0.5%. And then also the R squared number. Now, this is super important. We're going to cover this a little bit more in a moment. The R squared number is basically how much of the price movement can be directly attributed to M3. And in 2005 to 2014, it was 0.2 to 0.25. Now I'm going to move through this because we're going to explain some more of this over the next couple of slides. I don't want to hang around here too much because we'll end up repeating ourselves. But what we notice, if we jump forward to 2015 to 2019, again 12-month lag. But you can see that the correlation is increasing slightly from 0.45 to 0.5. So it's only a minor increase, but you would say that's an insignificant increase, or that could be within one standard deviation or whatever. So you wouldn't consider that to be statistically significant. What's interesting though is when you go to 2020. So when you go to 2020, the correlation increases to approximately 1, which basically means that there is a 100% correlation with M3 money supply growth since 2020, which is fascinating. Not only that, the beta increased to 0.95 to 1.1. So let's just call it 1. So basically, you've got a 1-to-1 relationship correlation and a 1-to-1. So for every 1% that the M3 grew, property prices grew by 1% 12 months later. And also, roughly 50% of the total price movement, so the R squared, can be directly attributed to M3 money supply, to M3 supply growth. The other 50% is made up of the other factors, so demand, supply, confidence, and policy. But what's interesting is that shifted from 0.25% in 2005 to 2019 to 50%. So it's double. Now let's go to the next slide. Unless you have any questions, Gabby, as we go, just jump in. Otherwise,
no, I'm fascinated to hear your hypothesis on why that shifted, but I'm sure you'll cover. Yeah.
It's one of the most interesting things to talk about. So, so what does R squared represent? I think this is very interesting to cover because again, some of this stuff is going to be very new to you guys, and I think it's important.
I don't know what R squared means.
Yeah. So R squared measures how well changes in one variable explain changes in another. So it's literally the coefficient of determination. So the proportion of variation in the dependent variable, here it's property price growth is what we're talking about, that can be statistically explained by the independent variable, which is M3 growth. So basically, if you have an R squared value of 0.0, then there's no relationship. So you can have a correlation, right? You could have 100% correlation, but you could have an R squared of 0, which means that just means it's coincident, right? And it's like it's happening at the same time, but it's actually none of it's got anything to do with M3, right? So it'd be 0%.
Yeah.
0.25 means that there's roughly 25% of the price movement could be explained by M3. 0.5 means that roughly half of property price changes can be explained just by M3 liquidity dynamics. And 0.75 would be that prices are 75% of the price action could be directly attributed to M3. So it's basically the R squared basically represents like what portion. So there can be a high correlation, but how much of that correlation is directly attributable to the specific variable that we're focused on. In this case, it's M3. Make sense?
So the lower the number, basically, it's coincidental. The higher the number, there's a more stronger direct correlation.
Well, yeah. So what you said is correct, but also it can indicate changes in market structure as well, which is the thing that I'm most interested in here.
Right. Yep.
So if we go back to, for example, 2005 to 2019, and by the way, it's the same in 1995 to 2005 as well, right? So I just didn't include it because it just was unnecessary because it was the same stuff.
Yeah.
Roughly 25% of the price movement can be attributed to M3. Now, it wasn't at a 1-to-1 ratio. So you would, let's say that elasticity was, or the beta was 0.5. So then you would say for every 1% of there's a correlation that every time M3 grows by 1%, that property prices would grow by 0.5% 12 months later. So there's a correlation that says that. But of that, 25% is attributable to M3, right? So not all of it. Okay. And the rest of it would have been more specifically indicated or more specifically driven by things like demand, supply, confidence, and policy. Are these other factors, right? So what's interesting is what we're talking about here is an increasing in the financialization of property. If we go to the next slide. And this is very, very, very important to understand. I was posting about it all in our Slack. I was like, guys, this is like, so from 2005 to 2014, only about 20 to 25% of housing price movements was statistically explained by M3 changes. The rest came from fundamentals, wages, population, construction, etc. 25 to 2019 is still basically the same. It was basically 25%. It really nothing really changed, right? So nothing really changed between those 2 points. And also the period before that, nothing really changed. It was all about the same. So the market structure had been in a certain way for like the last, prior to 2020, for like the previous, 30, 40, all of the data that I had said those basically, the R squared basically stayed the same. But in 2020, something changed. In 2020, it changed from 0.25 to basically 0.5. So nearly half, or we'll call it half of all changes in price growth can now be explained by changes in M3 growth alone with a 12-month lag. So if you have that, basically is a way of explaining that is if M3 money supply grew by 5% this year, we could reasonably expect that there's going to be 5% property price growth nationally, property price growth in 12 months later. Okay, does that make sense?
Yeah.
So in this case, R squared tells you how monetary the property market has become, which is really interesting because we're going to be talking. This is so interesting. So over the past 2 decades, that number's roughly doubled from 0.25 to 0.5, confirming my thesis that post-COVID, the property market behaves much more like a liquidity-sensitive financial asset. So that is to say that the market structure has now changed or is in the process of changing, and real estate is acting much more like a financial market than the real estate market. So it's acting more like the stock market. I'm not saying it's the same, but it's acting more in that way than it is in the traditional kind of real estate, because the traditional real estate market structure was actually more like a matching market model, because you would have different and this is, we're going to dig into this a little bit later, but it was driven, and it still is predominantly driven by home ownership, but that is changing, right? And this is the point, is that it is changing. So the property market has always traditionally been driven by home ownership, and home ownership is one of those things where it's not purely financially driven, it's emotionally driven. So a matching market is like dating, right? It's like Tinder. So what you're actually looking for is not just how many males and how many females are on Tinder or something like that. It's like, well, does that female like the look of that male? Does that male like the values of that female, or whatever, right? And so
there's a lot of characteristics to match up. Very complicated.
Exactly. It's characteristic driven. So when home ownership, right, is the predominant driver, and it still is, by the way, but it is that structure is changing. When home ownership, more about
the characteristics.
Yeah, it's more about the characteristics. Do I like the look of it? Is it in a place? Is it near a school that I like? Is the kitchen big enough?
Yeah.
All of these kind of things. But as it becomes more financialized, that changes. And also, there's less of that, and there's much more. It's much more the flow of money in the market tells us so much more about what is going to happen in the market on a go forward basis.
So what's the impact of this in terms of like property becoming more financialized? What's the impact for people?
Well, so it's a really good question. Let me take it in a slightly different direction and talk about like why this might have happened, and I think we'll end up with what it means. So in 2020, there was a flood of new capital into the market. Everyone knows it. There was QE, there was lots of money printing, there was all of this kind of stuff going on that was pumping money into the market. And what happened is, and also interest rates went to they went to 0.1% at the cash rate. So there were extremely low mortgage rates. So lots of people tried to enter the property market. They either tried to buy a home or they did buy a home. We saw a spike in home ownership. We saw all this kind of stuff happening, but also property prices went through the roof. And so post that was like all of us, like it went from like pretty much out of reach to almost exclusively out of reach for most people, home ownership. And so when home ownership becomes out of reach, yet people still believe in property as an asset class, what happens is they seek to invest. They go, okay, well, if I can't buy the home that I want to live in, how can I make enough money to be able to buy that home in the future? Or how do I participate in the property market in some other way? And so through a combination of, better technology that allows us to invest interstate and all of this kind of stuff and more accessibility, capital started to flow more into the investment side of the spectrum because people are seeking to make money rather than to buy a home. And so, and this is contributed to the financialization. Now, what that then points to is that whereas the market was driven in the past by fundamentals, right? So if you go back to, for example, the 2005 to 2019 period, where only 25% of the price action could be explained by M3 growth, which is also still quite high, but also remember there was only a 0.5 beta. So, like 12.5% or something of the price action was driven by M3 in some way, right? The rest of it was driven by things like, jobs, desirability, lifestyle, all of these things. And so when we talk at and this is an evolving thesis, so don't let's not pin me down to anything here. But what I find interesting at the suburb level is, and this is really, I only uncovered this yesterday, so this is all still early, but we have to start asking ourselves, if we look at jobs, lifestyle, and relative local affordability, what is the weighting between those? Because they can't be evenly weighted if the flow of capital through the markets is 50% of the price movement, right, in the entire market, then necessarily affordability, I suspect, and we need to prove this out, affordability actually becomes more of a driver than things like jobs and lifestyle, because actually capital flow is more important than even potentially migration, right? Because actually it's the capital flow, not the people and all of these other fundamentals. So it's moving away. It's actually changing. And this is why I say it's changing the market structure, because the market structure used to be driven by certain behavioral characteristics. People would want to move to a certain location for certain reasons. They would want to buy certain houses for certain reasons. They would want to do all this kind of stuff. But now actually it's interestingly, certainly a higher proportion of market movements are driven by the flow of capital. And this is also pointing to why property market cycles are shortening, because capital is flowing between different markets, chasing opportunities. And so whilst still, roughly 70% of the market is driven by home ownership, that is changing as well. So I think that this is going to change quite a lot, and also points to, I think it points to capital flowing into into cheaper, more affordable markets and all of that kind of stuff, and driving the markets more. So,
and I think if we zoom in as well on like the everyday experience of Australians at the moment, and everything we've kind of talked about on this show so far this year, is people are feeling the pinch in terms of their purchasing power just degrading in front of their eyes. And so people are feeling like they need to invest, which, you and I both believe people need to invest, but they're feeling that a lot more. So there's more investment activity. So even just that, keeping that in mind of like, it's the everyday experience of people as well is contributing to the more financialization of these asset types.
Yep, 100%. 100%. Yeah, because people want to participate in the property market, but they only have a certain amount of money, right? And so, yeah. Fascinating. Okay. So now we're going to move on to a different topic. Actually, let me just quickly sense check something. That's okay. I was trying to remember what I was.
Guys, if you're here live with us, if you got any questions about this, because again, throughout this week, as Goose has been researching this, he's kept popping out of his little research cave and being like, this is crazy. This is insane.
So if
anyone's having those kind of realizations, share them in the chat.
So Gabby, do you want to go back to slide 9?
Love to. Slide 9. There we go.
So if we have a look, so we've established that there's since 2020, there is now effectively a 1-to-1 correlation with M3 growth. And but with a 12-month lag. So what we can see from here is that in August 2024 to August 2025, M3 grew 6.8%. So what does that tell us about where the market is going to go over the next 12 months? That's a 65% acceleration of M3 money supply growth, right? We had 4.1% property price growth in the previous 12 months. We can reasonably assume that we're going to have 6.8% growth in the next 12 months, assuming that correlation holds, which I really, really, really think it will.
Because even if it's not 6.8, right, it's not pointing towards the downturn.
Well, no, definitely not. No. But yeah, I actually think it's going to be so. And we've also got to remember that this is an average, right? And I'm going to just simplify the average a little bit. But let's say the average, let's say the national average price growth was 6% over the next 12 months. That's not 6% everywhere. That doesn't mean all properties grow by 6%. If 50% of the properties grew by 9% and 50% of the properties grew by 3%, then the average would be 6%. Right. Or you could have an even wider dispersion. You could have, not going to do public maths on this, but you could have some markets go up by like 15% and some markets go down and some markets do 1% and, all of that kind of stuff and arrive at an average of 6.8%. And this is really where the distribution at the micro level kind of comes into play here. So the most interesting thing to me is it's like, okay, so we can actually see here, if we just look at M3 money supply growth, that's accelerating 3.1 to 4.1 to 6.8. Because if it was consistent, if it was 3.1% in 2022 to 2023, and then 3.1% in 2023 to 2024, that's 3.1% on 3.1%. So that would still be growth. It's not static. It would be growing at the same rate. So it would be consistent growth. But actually, you can see that the growth is speeding up, 3.1 to 4.1 to 6.8. Okay, so let us now move on and let's talk about something else that's really interesting. The RBA balance sheet. Okay, so most people don't think about this, but the RBA balance sheet is a really important factor when we think about liquidity in the market. So over the last 3 years, the RBA balance sheet has been tightening. It's been the longest, steepest quantitative tightening period in Australia's history. If we go to the next slide. So what does that actually mean? What does draining the balance sheet mean? So when the central bank balance sheet contracts, which is what you just saw in the previous slide, where it's actually going down, the balance sheet is going down. This is quantitative tightening. So the central bank is reducing its asset holdings, usually by selling bonds back into the market or letting existing bonds mature without reinvesting the proceeds. As these bonds leave the balance sheet, the asset side of the balance sheet shrinks. The liability side falls by mainly bank reserves, falls by about the same amount or by the same amount. And that's how liquidity is drained from the financial system. So the effect is that it shrinks the central bank's assets and liabilities. It reduces reserves in the banking system and liquidity tightens. So in short, quantitative tightening equals central bank balance sheet contracts, reserves fall, and liquidity drains. And I know that's a lot to take in, but let's try and get through it all, and then we can kind of ask questions and explain. So we go to the next slide. So what about quantitative easing? So what is that? So when the central bank balance sheet expands, this is quantitative easing. Now, a lot of people are more familiar with quantitative easing now because it happened in June in 2020 when there was a lot of money flooded into the market. It's quantitative easing. So that is when the central bank is buying bonds. So they're buying bonds from other people and they're giving other people money, and that injects liquidity into the market. So they buy bonds from banks or financial institutions or individuals, by the way, or institutional investors. The central bank pays for these bonds by creating new reserves, which show up as liabilities on its balance sheet. The asset side increases, and so does the liability side. So the effect is that it expands the central bank's assets and liabilities and injects reserves into the system, and liquidity increases. So in short, quantitative easing is when the central bank balance sheet expands, reserves rise, and liquidity floods in. If we go to the next slide. So to put it in, so if you're a little bit confused by that, you wouldn't be the only one, because it is a little bit, let's like, hang on a second, they're buying and they're selling, what's going on here? So this kind of simplifies it down a little bit. So if the policy is quantitative easing, then the central bank, let's just say, buys $100 billion in government bonds. That means their assets go up by $100 billion and their liabilities also go up by $100 billion. But liquidity goes up because what they're doing is they're injecting capital into the market because they're buying stuff from people and they're paying them money. So cash is going out and they're taking those assets and liabilities in. The opposite is also true in quantitative tightening. They're selling bonds, right? So if they sell $100 billion in government bonds, the assets go up by go down by 100 billion. The liabilities go down by 100 billion. So net's the same, but liquidity goes down because what they're doing is they're selling stuff to people. They're taking capital that is in the market and they're taking it out of the market. They're saying, I'll sell you $100 billion and I'm going to take that $100 billion off the market. So that's why liquidity decreases.
Can I ask a question?
Yeah. Yes.
I know you've got more slides on this,
That's
but
fine.
So QE, right? Generally speaking, you think QE means liquidity up, so asset prices go up.
Yes. Well,
generally, I'm generalizing.
Yeah. Okay, go on. Yeah. The true statement is that liquidity goes up. So yes.
Yes. Okay. QT inverse, liquidity goes down. You would assume then asset prices go down. And so why have we not seen asset prices go down?
Well, this is a very good question, Gabby, actually. It's a very good question. So, let me answer that in a couple of slides, actually.
Okay.
Because let me answer that in a couple of slides. It's a very, very astute question, right? So if we've been experiencing quantitative tightening, right, and theoretically liquidity's been getting sucked out of the market, why is M3 growth going up and accelerating, by the way? Right? So all right, hang on a second. So the government is sucking liquidity out of the market. Got it. If you just go to the next slide, we'll have a little look at that. The government's sucking liquidity out of the market. Got it. So why is M3 going up? And why are asset prices going up? Why is all that happening? Well, it's a really good question. And actually, there's a very bullish signal in here. Now, you can see from this chart, this just expands the view of the central bank balance sheets to the start of 2019. And so you can see that from 2020-ish, we went through a quantitative easing period and the balance sheet went up dramatically, right? So that was like heaps of easing. There was lots of money flowing into the market, all of that kind of stuff. And you're right, Gabby, asset prices went through the roof. They mooned. They absolutely hooned. But since 2022, we've been in a quantitative tightening period. And so, but asset prices have continued to grow over the last, since 2022. Like asset prices haven't gone down in aggregate. So what is going on here? Now, I'll cover that in just a moment. But so just laughing at a comment in the chat there. By the way, in the chat, let us know if this is all making sense to you guys. And so Catherine LeBlanc said prices did go down, especially in Vic, but not everywhere. The point there, Catherine, is not everywhere. And at the moment, we're focusing on the macro, not the micro. So we're saying like in aggregate, asset prices didn't go down, right? So slowed, yes, but I think maybe there was a brief period where national property prices went backwards, but very minimal, right? Considering we've had a 3-year quantitative tightening period. So, and by the way, I'll just point out that one of the things that I'm interested in is that it appears, and if you read the minutes, which I know is a very mundane thing to even
guys, don't read the minutes.
If you read the minutes from the last RBA meeting, a lot of the I know.
I mean, if that's your thing, go for it.
Yeah. Look. Anyway, so what's interesting is the language they use is getting more to the place where they're starting to use language which is suggesting that they may need to begin easing again. And now I pointed out here on the bottom right here that this flat period, so you see how the balance sheet has been contracting, and we very may there's a very kind of flat period at the bottom. Catherine, you can get the minutes from the RBA meetings and stuff. They publish them on the website, and you can also, by the way, if you use GPT Pro, it'll go and find the minutes for you and summarize them. So I don't actually read the minutes; I get the summaries. Potentially, we're at the bottoming of that quantitative tightening period, right? So you can see how it's gotten flat there in the last little section where I've put bottom ? Now, I would be remiss to say that without also pointing out that there have been 2 other flat periods in the prior 18 months, right? So just because it's flat doesn't mean that it has bottomed, right? But I'm curious and I'm wondering whether it has bottomed because of some of the more dovish language that they're starting to inject a little bit, and a few other signals that we're going to be talking about in a moment. So, but anyway, we can see the macro view here that quantitative easing, when that regime was in place, the balance sheet expanded, and you're right, Gabby, asset prices went up. Quantitative tightening we've had a 3-year contraction of the balance sheet, quantitative tightening, sucking liquidity out of the market. Why have asset prices not gone down? And I want you to really hold on to that thought, right? Because you would have to then ask yourself, what if asset prices haven't gone down despite QT? A, number one, why? And B, what if they stopped QT? And then what if they did QE? Right? Now these are the things that we really need to think about. So if we go to the next slide, because I'm going to explain why. So since December 2023, there has been a significant increase in private sector credit growth. Now, this is the growth rate, not the absolute value. So the year-on-year, jumbling up my words here. So private sector credit growth year over year increased by 50% since December 2023. So from 4.8% in December 2023 to 7.2% in August 2025. So if we go to the next slide, the private sector credit growth. So the total growth in private sector credit between December 2023 and August 2025 roughly equates to $550 billion in new money created over a 20-month period. Okay, so you got to remember that in a credit-based system, credit creation is money creation. An M3 money supply captures credit creation. So it's not just the actual physical printing of dollars and of notes and coins. It's also the expansion of credit. And so private sector credit includes business credit, but also significantly includes loans as well. So private sector credit grew by roughly $550 billion over a 20-month period. That's an average of $330 billion a year, and also partially explains why M3 money supply expanded by $206 billion in the last 12 months, even though the government was in a QT regime. So we've had $330 billion. It's actually been accelerating. So there's been more than $330 billion. It's kind of hard to get the exact numbers on this. I had to dig a little bit deeper to do that. But let's just call it $330 billion of money created through credit. But then also the government has been sucking liquidity out of the market. So you've got the government there with a straw sucking liquidity out of the market, yet you've got the private credit markets expanding money supply faster than they're sucking the money out of the market again. And that is why M3 money supply growth has been going up. So you'll notice the year-over-year growth, which is really, really interesting. Let me just make sure. Yeah. So if you look at the table at the bottom there, so M3 money supply growth and private sector credit growth. So in August 2022 to 2023, M3 grew by 3.1, private sector credit growth by 4.3. August 23 to 2024, money supply growth, M3 money supply 4.1% growth, private sector credit growth 4.8%. 2024 to 2025, 6.8% M3 growth, 7.2% private sector credit growth. So private sector credit growth and credit creation has been expanding the money supply, and some of that premium has been getting sucked out by the quantitative tightening regime. It's been sucking that out, which is why we don't just have net the total value of private credit growth showing up in the M3 money supply. Does that answer your question?
Yeah. So to summarize, it's kind of like, so if you think about M3 supply as a total basket, that's not just the RBA balance sheet. It's the RBA balance sheet and private credit levels. The analogy, I like the straw analogy that you said, but I was just thinking then about, like, it's like a car where the RBA is trying to put the brakes on in terms of like shrinking, but then somebody else in the private sector, the private sector has their foot on the throttle, on the gas at the same time, and it's like a little more powerful than the brakes. So it's moving forward.
Yes.
But you have those two forces within M3.
Yeah. Well, yeah, there's actually, yes. So the car analogy is good. But yeah, you've got, within M3, you've got, it's a total liquidity measure. So it's measuring the total money. So that includes credit, it doesn't include derivatives, it includes credit, deposits, liquid investments, all of that kind of stuff. So basically the liquid capital market in Australia,
Yeah.
right? And so then you've got one aspect of it is the RBA balance sheet, where they're sucking liquidity out, but then the private sector credit growth is pumping liquidity in at a
Got the foot on the
faster,
gas.
at a faster rate than it's being sucked out. So that is fascinating. So and that explains why M3 has been going up, even though we've been in a quantitative tightening period. And because of the relationship between M3 growth and asset price growth, that explains why asset prices have continued to grow, even though the RBA has been sucking liquidity out of the market.
Fascinating.
I know.
Yeah.
Let us know in the chat if you think this is fascinating as well. I think it's really awesome. But does that all make sense to you, Gabby? Is that all like kind of like you grokking?
Yeah, no, it does. It does. Yeah, it's I just think it's funny because I don't think anyone would say that they feel like we've been in a QT cycle. So it's interesting to think about it. But again,
totally.
there's more that goes into what we've been talking about in terms of like M3 growth. Yeah.
Totally. So all things being equal, right? Even if the government didn't change its policy, and even if everything if everything stayed exactly the same as it is right now, we could reasonably deduce that based on the continuing expansion of private sector credit growth and thus the expansion of M3 money supply, asset prices are going to continue to grow. We could reasonably deduce that if the one-to-one correlation holds, housing prices are going to grow by 6.8% in the next 12 months, whether the government does changes its stance on QT or not. Now, the interesting question to ask is, what if they did change their policy? What if they did start to ease monetary policy? What if that happened? And also, we had the other factors here that we're talking about, like private sector credit growth. So if you go to the next slide. So private sector credit growth leads M3. So as banks issue new loans and deposits, and hence M3, it rises 1-for-1. Monetary acceleration since late 2023 reflects a shift from central bank-driven liquidity to bank credit-driven, which is QE, by the way, central bank-driven liquidity, to bank credit-driven liquidity. The parallel reacceleration confirms that the private banking system has become the main engine of money creation, offsetting the RBA's balance sheet contraction. Which is, I just think, I don't know, I just nerd out on all this shit. But it's so fucking interesting to me, by the way. So let's keep going, because I think we then need to ask ourselves, okay, so where are we going then? So interest rates have only just started their easing cycle from 4.35% in January 2025 to 3.6% in August 2025. And if you go to the next slide, this, by the way, this would appear to conform to a mean reversion trend. So interest rates have been in a structural downward trend since 1990. So for the last 35 years, the only real main trend for interest rates has been down. Now, the 0.1% interest rates that we experienced during COVID and all that kind of stuff, will we get there again? I think yes, but I don't know when. I'm not going to say next year or whatever. But I think we have to think about where is all of this going? When I say all of this, I mean like all of it. So I would just say one thing here: technology drives deflation. And if technology drives deflation, governments can't afford deflation, because debt in the future costs more tomorrow than they do today in a deflationary environment. And so they need to continue to debase the currency. And the way they do that is by doing things like increasing liquidity and all that kind of stuff. So you can reasonably see that if we actually go to the next slide, and by the way, this is not a mathematical trend line, right? So
that is a line in Google Slides.
Yeah, for the avoidance of doubt, there's nothing mathematical about that red line on the screen, but it's just really to highlight the directionality of the trend. And so it's not unreasonable to think that interest rates are going to continue to come down. And if we go to the next slide, so interest rates have only just started their easing cycle, and meanwhile, trimmed mean CPI, so trimmed mean consumer price inflation, which is the preferred measure of the RBA, is trending sharply down. So it peaked at 6.8% in Q4 2022, and it's now just 2.7%. Now, with things like CPI, the trend is critically important, because it's not changing the trend is like trying to turn the QE2. It is very slow. And so when you have a trend that goes in one direction, typically it's going to continue to go in that. But you could make a policy change tomorrow and it's not going to suddenly change the trend. It takes time to kind of like shift its arc. So the fact that it is trending in that direction says it's got momentum in that direction. It's likely to continue in that direction. So if we go to the next slide. So trimmed mean CPI is trending sharply down, and yet unemployment is trending sharply up despite the record number of government jobs created over the last 12 to 24 months. So unemployment's trending sharply up from just 3.4% in October 2022 to 4.5% in September 2025. So we'll go to the next slide. So what actually is the RBA mandate? Well, the RBA mandate is to focus on two things. Number one is price stability. So that's CPI, consumer price inflation, between 2% and 3%, and full employment, which is an unemployment rate of between 4 and 4.5%. That's the official position of the RBA. Their main control mechanism is interest rates. And whilst both metrics are currently in the target range, so just a quick reminder, the CPI is at 2.7% in Q2 2025, and unemployment rate is at 4.5% in September 2025. So technically, both of those are actually in their kind of target range. The steep directional trend of each indicates that the most likely direction for interest rates is down. So the steep direction of the downward trend in CPI, which again, technology drives deflation. Hello, everyone. And also, technology drives the displacement of jobs. And so despite the fact that governments have been creating new jobs out of thin air and running massive deficits to try and keep the unemployment rate down, they're both trending in a very steep direction. So at some point, the RBA is going to need to make a decision on that. Now, so it's highly, in my opinion, it's highly likely that they're the most likely direction for interest rates is down. Now, for every 1% interest rate cut, borrowing power increases by about 10% to 12%. And given the incredibly tight supply in the property market, that translates to an additional 5% to 10% growth on top of the existing organic growth rate. So it doesn't pass through at a one-to-one rate. Now, it's actually, there's a whole bunch of academic studies on this, and I'd get distracted if I was to go and I was doing some research on it. So they did a whole bunch of research in the past, and typically the pass-through rate is, I think it's between 4% and 7%, or between 4% and 8%. But because we have such tight supply side dynamics in the market, that is actually increasing that to about 5% to 10%. So for every 1% in interest rate cut, borrowing power increases by 10% to 12%, but not everyone can buy properties. So that translates to additional 5% to 10% growth on top of, let me just restate that, on top of the existing organic growth rate. So if all things being equal, if we take the point of view, and again, no, I don't have a crystal ball, right? So all of this is just, hypothesis around what could potentially happen. But if M3 continues to have a one-to-one correlation with property price growth, and M3 grew by 6.8% in the last 12 months, and property prices, if we then, just for the point of this example, and this is not a forecast, right? This is just working through the idea. If property prices grew by 6.8% in the next 12 months, we would consider that to be the organic growth rate, and this is at a national level. If interest rates went down by 1%, then we could reasonably assume that there would be an additional 5% to 10% on top of that. So 6.8% plus, 5% or plus 10% nationally, right?
Mm-hmm.
So in addition to this, the RBA's unofficial mandate is to ensure consistent economic growth. And given that 8 of the last 9 quarters have been in a per capita recession, they're under increasing pressure to stimulate the economy either via interest rate cuts or moving from QE to QT. No, from QT to QE, that should say, right? Wrong way around. Yep. From QT to QE. So the position that I would like, or the thing that I would like to posit here is that the RBA is getting into a position where they're going to need to either cut interest rates or stop QT, potentially start QE, or both start QE and cut interest rates. So some version of all of the above. What do you think about that, Gabby?
I mean, I think it makes sense. I was just thinking through, like, with people that are listening, I would love, again, if any of this you disagree with, like maybe we're going to move on to the other 4 forces next, because we're still covering liquidity, but
we've got so much stuff to cover.
We've got so much stuff to do. But on the liquidity side, like if there's anything that's still, you're like, I don't quite buy this, I'm not super on the fence. Again, the question they were asking in the episode is the property market about to explode? And if you're still on the fence or you still are not sure, I would love to hear in the comments on what your perspective is, or what you disagree with, or what you are unsure about. Goose, should we carry on?
Yeah, we should, because I just realized how much stuff we still got to get through. So we'll go through this.
Yeah.
We'll go through the supply and demand section a little bit quicker, because I think it's stuff that we've already talked about a little bit in the past. So we'll go through that a little bit quicker.
Cool.
But yeah, let us know in the chat. I think it's great. Let us know in the chat if you agree or disagree, what questions you've got. Let us know in the YouTube comments if you've got any questions, agree, disagree. So let's move on. So that broadly tackles the liquidity side of the conversation. And broadly, my point of view is that private sector credit growth is going to continue to drive M3.
Yeah.
But also, the RBA is almost certainly going to be moving into a monetary easing position, and that's going to accelerate things even further. So let us crack on.
Yeah. I'll just comment, like, it is very cool to see that correlation that you've been working on.
It's so cool, isn't it? I'm glad you think it's cool. That kind of thing. That
You're
that
cool.
might even.
You're so
yeah.
cool.
Does that mean that you think I'm cool?
You're so cool. Wow.
All
You're
right.
so smart and cool. Anyway,
that's
supply and demand.
Supply and demand. All right. So supply and demand. So let's just go to the next slide. So the thing about this is we already know that we have chronic undersupply and chronic demand. So we're going to go through these pretty quickly. I'll just read through these slides, and then we'll get to some of the other juicier stuff. So demand is already pretty much locked in. In 2024, Australia's population grew by 445,900 people. That's 1.7%. 87% of that was migration. That's the equivalent of dropping a city the size of Canberra into the country. So wrap your head around that. In 2024, there was enough immigration that we basically created an entire new Canberra worth of people that we dropped into the country in 2024. And the population growth forecasts are forecasting that we're going to grow by 1.2 to 1.7% every single year. And again, that's 1.2 to 1.7 on top of the existing number. So, it's basically roughly another Canberra of people every single year until 2032, taking us to 30 million people. If we go to the next slide. And you can see that this is not a new thing. So we had a slight slowdown in the growth rate in 2020 because of COVID and all the lockdowns, but then it's just continued. That trend is almost perfectly.
Are they actual numbers?
Yeah.
That's wild how straight that is.
I know, it's ridiculous, right? So this is not a new thing, right? So by the way, Catherine, yeah, I noticed that we sort of look like we are wearing matching shirts. Anyway, it's fine.
Shirts.
Anyway, so this population growth story is not a new one, but it's really catching up with us. And the thing is, go to the next slide. It isn't optional. Migration has become an economic necessity because without it, the workforce shrinks. We have an aging population. We have low birth rates. The tax base erodes and the economy tanks. So we need to have the immigration. And globally, in a world of instability, Australia looks like a lifeboat. So we've got good rule of law, good quality healthcare, world-class education, high quality of life, and people and capital need a safe harbor. So if you live in, I don't know, India or the not comparing India to the Democratic Republic of Congo, but I'm just saying if you're somewhere else in the world where your opportunities or your standard of living might be lower, or your sense of personal security might be lower, or any of this kind of stuff, Australia looks like a bloody good option. If you're Argentina, if you're in South America, Central America, most of Asia, most of Africa, I mean, bloody Europe is falling apart at the seams as well. So pretty much for most of the world, Australia's going to look like a very good place to go. That inbound demand from both people and capital acts like a shock absorber, cushioning downturns and fueling the next upswing. And we've also got a systemic housing shortfall. We've talked about this before. Building approvals have fell from 16,800 a month in 2014 to 13,100 a month in 2024. By the way, that trend hasn't really changed. And that's a negative 2.2% compounding annual decline over the course of a decade. So we build roughly 176,000 dwellings a year, but we need about 220,000. That's a shortfall of 44,000 homes a year, every year, compounding. So the current deficit, the current shortfall, the current amount of properties that we're behind currently is about 300,000 to 400,000 dwellings. That's like being short an entire Gold Coast worth of homes today. So that means that what we would need to do to have enough houses for all the people that want them today is we need to be able to click our fingers and suddenly have an entire Gold Coast pop into existence to house all these people. But yet every year we're falling roughly one Newcastle worth of homes behind. So we've got a Canberra's worth of people coming into Australia every year. We're short by a Gold Coast, and every year we fall behind by Newcastle, which is just pretty wild to think about it. And this isn't a temporary mismatch, it's a structural failure. So to catch up, we'd need to build the equivalent of 1.4 Canberra's worth of housing every year for 10 years. Can you imagine that? Building, anyone who's been to Canberra, it's not Australia's biggest city, but it's definitely like it's a major going concern. It's a whole city.
Mm-hmm.
We'd need to build 1.4 Canberra's worth of housing every year, like clockwork, for 10 years straight, spread across suburbs and cities across the country. We're not even close. We don't even have a plan to do that. Like, even if you had a plan to do that, it'd still take years to even start. So until supply is fixed, which is going to take decades, prices and rents face relentless upwards pressure. Now, this is where we're going to get into some interesting stuff. So, and again, I'll try and move quick-ish because I'm mindful of time. But this is interesting. Again, this is any of the slides that look like this are all from the Cotality monthly housing chart pack. What's interesting here is that the volume of new listings is down 10.3% from the same time last year, and negative 1.3% shy of the previous 5-year average. So not only do we have increasing demand, we actually have significantly less new listings coming onto the market. So there is a supply shortage. And it's not just a shortage relative to the demand. There's actually less new listings coming onto the market. So there's 10.3% less property listings this year than there was at this time last year, and there's 1.3% lower than the 5-year average, which is pretty crazy. So that tells us that there's significantly less new properties coming onto the market. If we go to the next slide, Gabby, this next slide is the total amount of listings on the market. So the previous one was new listings coming onto the market, and this one is total listings on the market currently. So since the start of winter, total listing levels have declined from negative 14% or negative 14% below the 5-year average to negative 20.2% below the average, with properties being absorbed from the market faster than they're added. So compared to this time last year, the 28-day count of listings is down 13.3%. So there's chronic demand. There's less properties on the market, less properties coming to market, and the properties that are on the market getting soaked up faster, quicker, and that's decreasing the amount of current properties on market as well. Let's go to the next slide, because I think we've covered that. Like, not only are we not building enough, but also the current stock we've got, there's less coming to market, and more of it's getting soaked up faster. So we have we have less properties available to buy today than we have had at any point in the last 5 years, which is crazy. So the annual rate of growth in national rents went up by 4.1%. Ooh, where did we hear that number? You've gone one slide too far, Gabby. Go back.
Cool.
Yeah, so the annual rate of growth in national rents went up by 4.1% over the last year to August. Where did we hear that number? That is the same amount that national property prices rose over the last 12 months. So rents have risen at the same rate as property prices, which is crazy, right? That is actually crazy. Because typically property prices move faster than rents, because rents are driven by wages and all that kind of stuff. So the fact that that rents have risen at the same speed as property prices over the last 12 months, that tells us something very, 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 very important. If we go to the next slide. So you can see here that over the last couple of years, gross rental yields nationally have basically been flat, which is fascinating, because that basically means that rental growth rate nationally is keeping up with property price growth nationally, which is very interesting, because what that points to is the fact that there is so much demand for housing that even as prices go up and even as more investors come into the market, we'll talk about increasing investors in a moment, even though the percentage of investors is increasing, the demand is so high. Because you imagine, like, let's say that we suddenly flip the market and there was 70% property investors, and so all of a sudden there was twice as much rental stock on the market. You would reasonably assume that rents would go down, right? Because you would have an oversupply of rental properties. Therefore, rents would go down because they would have more to choose from. The fact that, and we're going to cover this in a second, the fact that there are actually more investors in the market today than ever before, yet rents are rising at the same rate as property prices, tells us that there is so much pent-up demand for rentals as well as purchases that there is just simply not enough housing to go around in the market, despite the fact that there's more and more rental stock coming onto the market in relative terms.
Yeah, I just wanted to point out as well, because Charlie and Peter made a comment in the chat about holding costs basically for property investors are going up as well. So I think that's having some impact on landlords feeling like they need to increase their rents as well to some degree to at least try and cover some more of the costs of holding their assets.
So I hear what you're saying, but
you don't think it has that big of an impact?
No. It's just the market decides what the rent is.
Yeah.
Right. So if I own a property and the market demand for rent to pay at my property is $400, and I decide that that's not enough profit for me, I want to charge $800. How many tenants will I get? None.
Yep.
Right. I just won't get any tenants. So the market does set the pricing to a pretty significant degree because property landlords don't want to have empty properties and all of that kind of stuff. So the fact that there is enough demand that that price elasticity is allowed to follow property price growth, it's crazy because what we would reasonably expect is that rents would not be keeping up with with property price growth.
Yeah. Well, it's like if you had a banana and you had two people who really wanted a banana, and you said, "Hey, would you buy this for $1?" And they're both like, "Yes." And you're like, "Okay, would you buy it for $2?" And they say, "Yes, I would buy it for $2." And then you keep increasing it until one of them kind of decides, "Okay, that's too much for me to pay for a banana." And then suddenly you've sold the banana for $70.
Yeah, it's so funny because I was thinking of an analogy and I was going to suggest apples. I was like, yeah, if you're selling apples, right? If everyone thought that apples cost $2 and you decided to sell your apple for $5 because you want to make more profit, then maybe you just wouldn't sell any apples, So yeah, like market demand dictates the pricing. You can't raise rents further than the market will tolerate paying, within some reasonable margin. So what this points to is we're talking about supply and demand. So there is such a chronic shortage and such a chronic demand that rents are actually tracking price growth. Right. So if we go to the next slide, the percentage of investor lending has increased sorry, let me just gather myself. So the value of new investor loan commitments rose 1.4% over the quarter to 32.9 billion, up 6.9% over the year. Investors continue to make up an elevated share of total loan volumes, 37.6%, and loan values, 37.7%. Now, if you actually go back to, if you follow the dotted line, back in 2020-ish, it was less than 30%, right? The long-term average has been about 30-ish%. What we're actually seeing since, if you look at that chart and if you look at the dotted line on that chart, that's the national. You can see if you have a look at the bottom, you've got June 2015, June 2017, June 2019, June 2021. So if you look at where the bottom of that was, right? The bottom of that was roughly in 2020. Since 2020,
25%.
Yeah, since 2020, we'll call it 25%ish, maybe 27%, something like that. So since 2020, the percentage of loans to investors has only gone in one direction, up and to the right. And this again points to the fact that the real estate market is becoming increasingly financialized. It's been increasingly treated as an investment class, not just a home ownership class, right? And also, despite the fact that we're now approaching close to 40%, and in New South Wales, it's 43% of loans are to investors, by the way. So we're approaching 40% nationally, investors, whereas used to be about 30% roughly was always the sort of the number that I worked on. Even though we're approaching 40%, and that would in principle increase the number of rental properties on the market, which then if there's more rental properties and not enough demand, rental prices wouldn't go up, but rental prices are going up as fast as property prices are going up, despite the fact that the number of rental properties available, i.e. investor owned properties, is going up and is nearly at 40%. So this to me is completely mind-blowing, because what we're actually saying is not only is there such an incredible force of demand that we just cannot satisfy it, that prices are going to continue to go up and rents are going to continue to go up. but it's also showing us that the property market is becoming increasingly financialized, which is the point that I was making earlier, where capital flows are going to dictate markets far more than fundamentals will. And we're at a point now where 50% of the price movement is directly attributable to M3 money supply growth. Right. So this is again pointing to the idea that the market structure is changing. We're moving away from typical real estate market fundamentals into much into more of like a liquidity driven. It's actually behaving much more like a scarce, hard, desirable, liquidity driven asset. Right. It's behaving more like it's completely changing.
I don't want to get too negative here, but what is the end state of this? Like, where does this go?
Oh, okay, that's pretty easy. So the people who own the assets will get rich, and the people who don't own the assets are going to get poor. And if we go back and it's really that simple. It's really that simple. And you need to decide, if you're listening to this, if you want to be part of the ownership class or the consumer class, and that's really the only decision you need to make. Because if we go back to the example we used previously in the Great Melt-Up episode, in Weimar, Germany, what happened? Because again, what we're actually experiencing right now is currency collapse. That's what's happening, and amongst many other things. But what happened in Weimar, Germany, is the people that own the houses, their asset values went up, whilst the real cost of their debt went down. Right, so they were able to then actually buy more properties, and so they were able to own more properties. So people couldn't buy homes, and so they were forced to rent. And so rents went up because rents were like the value of the German mark was worth less. So rents went up. The people that owned all the assets, they just went and started collecting more and more assets, and life was pretty good. And if you didn't own assets, you were burning bricks of money to stay warm, because it was cheaper to burn money than it was to burn firewood. So where does this go? Where is this going? Well, this is going to the place where if you don't own assets, you will be left behind, which again points to the financialization of the real estate market. Because people are going, I will never be able to own a home, but damn, if I don't get on this ladder somewhere, somehow, some way, I am going to drown at sea. And so they are then saying, well, where can I put my money? Not where do I want to live? Where can I put my money? And they're acting like investors trying to capitalize on an asset which is growing because it's being driven by money supply growth, and the value of our currency is being debased in nominal terms, which is driving up asset prices, and people want to participate in that so they don't suffocate. And more people are waking up to the fact that their money is losing value and they're getting further and further behind. So my thesis is that this financialization of real estate is going to continue. It's going to be a trend that's going to continue on. And this is not, by the way, I saw a letter from a real estate industry organization kind of, lambasting companies like Dashdot, I guess, saying that we're treating real estate like a financial asset when it's not supposed to be that way, or whatever, some archaic waffle. But the reality is, it's the market structure that is changing. The reality is, it's the fact that home ownership became insurmountably unaffordable in 2020 when the government printed too much money. Yep. Right. So all of these other factors are changing the market structure, the drivers around how and why people are making decisions, how and why capital flows through the market, what things are going to affect the asset prices on a go-forward basis. This is what I mean by the market structure. It is fundamentally changing. Now, that is, again, this is also going to point to the fact that cycles are going to be shorter. We'll have an upside bias, because I think it's unlikely for property markets to go significantly down unless they're significantly overpriced. Potentially Melbourne had some of that experience, but Victoria, by the way, broadly didn't. Melbourne did, right? So it's just going to change the flow of capital through this. But you're right. If you don't participate, you're going to get left behind. So you have a choice: either get on the lifeboat. You need to own scarce, hard, desirable assets, or in 5 years, you're going to be in a very bad place, right? That's all I'm going to say. I'm not here it's not fear mongering, by the way. Look at the opportunity. Like, if you look at this, go back and watch this. There's a couple more things to cover off as well before we wrap things up. Go back and watch this again. What I'm mapping out here in this whole presentation is, like, guys, this is going to continue to go up. If you know that something's going to continue to up, I think I used this example with you the other day, Gabby. So if this was, I don't know, 500, 1,000, 2,000 years ago, and you were living in a small tribe on an island somewhere, and nobody understood how tides worked. Sometimes the water came in and sometimes the water went out, and nobody knew why. It was just some magic that happened. But you sat on the beach every single night and you happened to notice that when the moon was in certain phases, then the water came up in a certain way. And when the moon was in a different phase, it went out in a certain way. And then you were able to, by looking at the information and the data that you could collect, deduce that a tide was going to happen at a certain time. And then you were able to place bets on that because you'd observed the information in your environment, and you're like, okay, I've now tracked this. And what happens, like clockwork, is every 6.5 hours or whatever it is, the tide comes in and then it goes out again. And you could reasonably calculate, and then you'd be some magician. You'd be like, oh my God, I can calculate. It's the same thing, but instead of the tide, it's capital flows, it's assets, it's asset prices, and it's not that hard. You just need to develop the conviction to understand where this is going. And this is what I'm trying to show you, is that everything is here. And we can continue to uncover new and more exciting ways to convey this message. But the reality is that this is the most incredible moment for investing in probably since the start of investing as a concept, right? It's wild. But you have to get hold of it. It's not going to last forever. And on the other side of this it's probably not going to be that good for people who don't own assets.
Yeah, the thing that frustrates me about that, the commentary about like the property shouldn't be used this way. It's like, sure, we can have that moral stance. I understand the I guess emotional desires for that, for society to be a little bit more fair, I suppose, and the intention behind these kind of messages. But using that tide analogy, it's like, what are people actually meant to do? It's like they're expecting that everyone's just going to sit on the beach and just watch the tide happen, and then all of their money just gradually disappears. Like, it's not like, what else are people meant to do other than invest when we're not in control of it, Well, I just hate the encouragement of like, you shouldn't participate because you're contributing to it, when reality, it's not really how it works.
No, it's like it's just so ridiculous. It's like, it's like, yeah. Anyway, we could come up with a million analogies, but you're 100% right. The reality is it's a free market decision. So if you don't, like, if we want to change this, we need to build more houses. It is that simple. If there were more houses, if there were twice the number of houses in desirable locations or whatever, or dwellings than there are today, we wouldn't be having this conversation, right? Because it would soak up all the demand, right? And it'd be very different. But the fact of the matter is, it's not. So solve the problem or deal with the consequences. And the consequences are that the asset becomes financialized because it is extremely scarce. We covered in a previous episode, it's scarcer than gold. Right? It is one of the scarcest. Australian residential real estate is one of the scarcest assets on the planet. Not only that, it's yield bearing. Gold is not yield bearing. Bitcoin is not yield bearing. Australian residential real estate is backstopped by the entire Australian economy. It is scarcer than gold, and it's a yield bearing asset. Like, what? Like this? It's crazy. And then people are getting further and further behind because the currency keeps getting debased and their money buys them less and less every single year. And then people are concerned that, we're financializing something that is scarcer than gold. Like, people want to store their money in something that's scarcer than gold as a yield bearing asset. I mean, it's crazy. It's ridiculous. Of course, it's the obvious choice. Anyway, let's carry on. So confidence and policy, the last couple of points here we'll touch on as well. So confidence is really, really important. So consumer confidence is bouncing back. We'll just jump to the next slide. Consumer confidence is bouncing back in a very, very big way. It went down for a very long period of time. Since COVID, it basically went down. It went down from March 2019 to November 2022. Consumer confidence fell off a cliff, right? And it was down. It was down really, really chronically low levels. But from November 2022, it rose from 78 points in November 2022 to 98.5% in August 2025. So we can see that's a nearly a 3-year upward trend, right? Which is really, really good. So consumer confidence is returning to the market. And when people are more confident, they spend more money. So there could be liquidity and low confidence, and then people hoard their cash. But when people are confident, they want to deploy their cash. They're optimistic. They're trying to take more chances to get further ahead. Plus, you got something to say on it?
I was just going to make a comment for all the business owners that are watching. I'm sure that seeing this consumer confidence graph, you probably felt the pain through that period, obviously post the COVID pandemic, but you can see how low people's confidence in the economy and everything generally, how low that was been. So if you went through a period of really struggling with your business, this could be contributing to why, because it was just more difficult to run businesses with clients and customers and things.
100%. Yeah. I mean, like, I know for Dashdot, the single biggest indicator of, for us has always been consumer confidence. Anyway, so that's bouncing back. So that's good. That's good for the economy and that's good for capital flows. But then also from a policy standpoint, the first home guarantee scheme. So in October, the first home guarantee scheme came into play, bringing with it $12 billion to $28 billion of fresh demand. When you pump billions of dollars of fresh demand into an asset that is already scarcer and harder than gold, you create structural price acceleration. Now, you can go back to the episode where we covered that. I think it was called, I don't know, scarcity.
First home guarantee scheme?
Was it? I thought it was property scarcity, stock to flow. Anyway, we can put a link to it somewhere. So I did a big analysis on the first home guarantee scheme to understand what is the actual impact. And the actual impact is 3% to 6% national uplift in year one. So if we go back to that.
On top of everything else.
On top of organic growth, right? So let's do a quick recap. So if the M3 correlation holds true, then we're already looking at 6.8% property price growth. Go back a slide, please. If the M3 correlation holds true, we're already looking at 6.8% price growth, national price growth in the next 12 months. Plus, if interest rates came down by 1%, that'd be an additional 5 to 10%. So let's just call it 16% property price growth, just for simplicity, simple maths. Nationally in the next 12 months. Plus, let's call it another 4% national property price growth in year one, based on independent modeling. That's 20% price growth potentially. Don't quote me on that. But potentially, you can see how all that ladders up in national property price growth, just on the policies, the scarcity, the capital flows, all that kind of stuff. But by the way, the first home guarantee scheme is not going to be evenly distributed. It's probably going to be roughly 5% to 10% growth in the areas that first home buyers actually target, which is going to be lower price points, so $500,000 to $700,000 price point. And again, all that's in addition to organic growth. So it's all moving in one direction. Okay, let's go to the next slide. So what does all this mean? Well, as we've covered, liquidity is going up. Liquidity conditions are likely to be easing. There's chronic demand. There's chronic undersupply. There's increased financialization and capital flows in the market. Consumer sentiment is improving, and policy intervention via the first home guarantee scheme is stimulating more demand, which to me says the only way is up. The question is, how high is up? And I think it could actually be quite high. And just as a quick reminder, if we go to the next slide, that this is not going to be evenly distributed. So we've covered some of just a few points of the 5 macro forces. There's lots more that we could unpack, but we didn't have enough time for it. But those 5 forces being liquidity, demand, supply, confidence, and policy, and that sets the overall direction of the market. But then you've got to remember that this is not going to be evenly distributed. So we then need to then work out how to find the right location, the right property in the right place at the right time. And that's really the micro level. And that comes down to jobs, lifestyle, and relative local affordability. And what we might find is that in some of those locations, property prices might grow by 20% or even 30%. And then in some other markets, property prices might grow by 0% or 5% or something like that. It's not going to be evenly distributed. So even if the property market in total goes up, it's not going to be evenly distributed growth. So you need to make sure you're finding the right properties in the right place at the right time, so you can work out where the capital flows and where the price growth is going to be concentrated most. So that is it.
That is it. Great, Finn. So I guess the overarching question is the property market about to explode? Guys, if you're here live, do you think yes? Do you think no? Let us know. Do you
think that I've just presented a whole bunch of waffle? Let us know.
Waffle emoji. Is there a waffle emoji?
I don't think there is a waffle emoji. It should be.
Damn. Is there a pancake emoji? Anyway, if you think yes, chuck us a yes. If you think no, say no, or waffle emoji. I think yes. Personally, I think yes. I think all the research and all the hypothesis that you put together through this, Goose, I think it's, again, we talk about this every week, but the more and more you peel back the curtain, the more you can see how it can only really go one way, right?
Yeah.
Yeah.
Yeah. And I think it's, by the way, and I think it's very important to just remain critical and curious. And that's what I do. I know that people might just think that I'm only just looking for reasons that the property market will go up, but I promise you I'm not. Because as a business owner in this space, if the property market is going to go down, that's actually far more important for me to know. Because it's reasonable to assume the property market's going to go up.
Yep.
But if the property market was going to crash, our business would have a problem that we would need to solve. And so when I'm looking at all of this kind of stuff, I'm not just trying to find reasons to believe that the property market is going to go up. I'm just trying to look at what information there is so I can make better decisions. And just the fact of the matter is that everything I look at, so just really just points in one direction, because I can't see that there would have to be some crazy black swan. And even if there was, I don't believe that governments will allow us to fall into some kind of recessionary black swan environment. They'll just print more money. So, for me, I'm extremely bullish. And the reason that this is really important to me is if property prices were just going to go up by 5% a year everywhere, evenly, all the time, then, fine-ish, but they're not. Property prices, I think, are going to accelerate. And there are too many people who are going to get left behind if they don't take action on this. And so the reason that this is important for me to talk about, and the reason that I continue to want to find new ways to go, okay, let's look at this, let's look at that, is because I want people to understand and take action. Now, maybe taking action is working with Dashdot, and I hope you do. And, I would welcome you with open arms. And by the way, if you want to talk to the team, I think there's a link in the description, or you can head to dashdot.com.au/discovery, and you can book a time to chat with the team. And look, maybe it's not a fit. And honestly, we have very limited capacity. So maybe you don't get to work with us, right? But the point is, you've got to take action somehow. And if it's with Dashdot, brilliant. We've got a fantastic track record. But doing something, as long as you're not buying the wrong property in the wrong place, wrong time, is going to set you up far better than doing nothing. Doing nothing is the only way to guarantee that you are going to get poorer over time. Mm-hmm. Doing nothing is the only way to guarantee that you are going to end up worse off tomorrow than today. It's the only way to guarantee that you will not be able to provide for your family in the future. It is the only way to guarantee you're not building a life raft. So doing something, anything is better than nothing. Now, if you want to have the best shot at getting it right, particularly in property or specifically in property, then I would highly recommend working with Dashdot. But doing something has to be first on the agenda, taking action, getting off the couch, getting into actual movement, because this is only going one direction. And the longer you wait, the further you're going to be left behind. And that is the one thing that I always think about. The way that I think about it is that, we have a lifeboat and we are slowly sailing away from the shore, and we keep letting out more and more line to try and help the people that are still on the shore to get hold of something, and hopefully they can, pull themselves onto the lifeboat. But at some point, we're going to run out of rope. And there's going to be a whole bunch of people standing on the shoreline that we just can't help. And I know that time is coming, and that day will come one day. And all I'm trying to do between here and there is try and get as many people on a lifeboat as possible. That's it. So hopefully you check this out and take some action. And by the way, I'd love to get feedback in any of the platforms, whether it's YouTube or in the community or whatever, if you've enjoyed this analysis and what your takeaways are as well, because I think it's a lot to unpack in here. Cool.
Mm-hmm. Cool. That made me really sad, actually.
Sorry.
No, it's okay. It's again, this is why we do this every week, because we're just trying to find new ways to help the message cut through to more people so that they can grab that line. And again, if you have been watching this, if you've gotten value from this, and you think that there are other people that you want to be able to help, and you think, hey, this is a really great summary of why people in my life are still skeptical about property. They're probably thinking that the boom is about to be over, like it has to be over by now, surely. This is probably a good thing to send them, to show them, like, actually it's still gonna keep going up. So let's figure out how we can get you on that lifeboat as well. So just share this episode. I think again, we're doing our best to try and reach as many people as we can through this show and through Dashdot as well. But if you can spread that as well with people that you care about, just share this episode and let's try and change more lives together. So
nice.
we're going to do Q&A, but I've done a scan through and I don't think there's many questions that we haven't already kind of covered throughout the way. So
no, which probably just means that like people got overwhelmed with all the information. I
maybe.
think so.
And again, if it was overwhelming, the replays on YouTube, just go back and listen to that as well. Awesome. Cheers, thanks guys. Episode.
No worries.
Thanks. See you next week.
See you next time. Bye.
Bye.